let me start, Alyse, let me start with you. I want to ask, you had a presentation, which you nicely sent me last night, but this is from 2016. This was the summer 2016, and you wrote at the time that the distinction between investing and gambling is unclear when it comes to crypto. So that's, whatever, that's 18 months ago. Is that distinction clearer now?
Well, the pace at which the distinction is being made is slower than I would have liked to have seen. And so I think that my concern today or in 2017 is that as the price of cryptocurrencies pick up and people realize there's an opportunity to make money by investing in digital tokens or currencies, that the value of the technology and actually what you're investing in gets a little bit lost. The thread of the story is lost. And so hopefully in 2018, we push forward to get back to the core technologies and traditional venture capital diligence so it looks less like gambling and more like venture capital investing.
I'm incredibly bullish on the space in general, but to Alyse's point.
You need to be, right?
Yeah,
I mean, well, you raise money to do it.
Well, yeah. A bunch of it. And we've been doing it a long time. I sort of bet my career on the space. 5 years. 5 years. 5 years.
Long
okay,
time.
That's a long. I mean, but one of my friends recently said, "I feel like we were given a magic wand and all we got was a crappy casino," which I think is a fair assessment at the current time. But at some point, it's this same. People will speculate when they see an asset class that they want to partake in. And I think that a lot of what is, no one really knows what good is yet. And so people are taking long shots, hoping that the value catches up with the speculation. I think it's exciting.
I agree with that. And by the way, like you look at folks like Adam and Bart, people who have been in the space for a long time, kind of the analogy to the 90s. I was playing this in my head last year when you look at what happened with ICOs and maybe venture capital in the 90s. Early 90s, you had engineers that were really talented who felt really passionately about what they were doing, and it was hard. It was hard to raise money, but maybe there were higher quality projects or higher quality talent. As that became sort of a self-fulfilling prophecy, you saw this feedback loop where it became easier to raise money. You saw supply of capital raised to meet the demand of entrepreneurs who were raising capital, and you saw quality diminish over time. And I think you've seen a little bit of that in the ICO market, but for those who were in early and know what to look for, there were and will continue to be great opportunities.
But when you look at the ICO market, we're jumping around a bit, and I'll focus in. But with the ICO market, I looked at some stats recently, and if you look at the amount of money that was raised in the ICO market last year in 17, which was starting from virtually nothing. So that it took venture capital as an industry from when it started 40 years to get to that sort of volume. Now, I understand inflation, different technologies, et cetera, but 40 years is a long time. So I guess, Bart, is it safe to say, are we kind of in the frenzy state right now? And if we are, is that a dangerous state to be in from a return standpoint? A lot of people here are LPs. Is this kind of an industry where you feel you almost have to potentially take your losses now to be able to get gains later, to understand it?
Yeah, I think the more interesting thing to look at is not the size of how much ICOs have raised. There's been about $5 billion in ICO capital that's been raised. But who is participating? We're looking at a wholesale enlargement of the concept of venture capital. It is no longer the business of elite kind of legacy generalist firms on Sand Hill Road to anoint what project is going to be the winner and what's going to be the loser. What we're seeing is engineers are basically building protocols and decentralized applications, and they're crowdsourcing capital from their future users. They're turning their users into stakeholders, and their stakeholders become evangelists. It's a powerful concept. It allows new sources of capital to fund projects on kind of like Kickstarter on steroids. But instead of just being considered a user where you're data mined or tracked or Google or Facebook own your data, you're a stakeholder in this tokenized network. So people like to focus on the price of Bitcoin, not the important ideas of like censorship resistance. And people like to focus on the transaction called an ICO, not this concept or this idea of tokenized networks, which are very powerful and put the kind of control back in the hands of the founders and the engineers in many ways.
By the way, Adam Ludwin was out here and he gave me a shout out, and I wasn't in the room. I'm hoping he's not in the room right now. I'm about to give him a shout out. So he said he had everyone raise their hand to see if anyone was using Bitcoin productively. And no one raised their hand, including me. I didn't raise my hand either, even though technically my entire business is built on it. But actually, anyone who owns Bitcoin is using it productively because it is censorship-resistant money. It is stored outside of the system. And I don't think people understand how powerful that is. We in the US, we focus on the US, but this is a global revolution. This conversation that's up here on stage is happening in every country. Like, governments have to make decisions on it. That's crazy.
Okay, let me ask, let's focus on the investment side. Adam, so let me start with you on this. When you started Boost, the idea, and it still largely is, you're investing kind of as a traditional VC in untraditional things, right? You're taking equity stakes in companies. Is that still the majority of what you're doing, or are you now also buying, whether it be direct crypto or buying tokens of companies?
So up until 12 months ago, ICO wasn't a thing.
Right.
So that's a new thing that we've all had to adopt as a potential where is the value situation. It started with just equity investments based on companies that were building on top of Bitcoin. And then the word Bitcoin became like, no one liked it. Like everyone was like, that is poison. And so it changed to blockchain, even though everything was still happening the exact same way. And then all of a sudden, Ethereum launched the ERC-20 contract, which is the smart contract on the blockchain to be able to crowdfund from everyone in the world. And this happened, like we're all here because of that, basically. So last year was the year of Ethereum, and that was a really exciting thing. So to answer your question, I'm still talking. We do everything. So I've done more actually we might be even, but we've done more interesting equity, crypto, token. Related deals. We invested in the companies before ICOs were a thing, and then they became ICOs. So
did you get screwed on the equity of those companies?
What do I own? And no, the answer is we have good relationships with our founders. They've all made good up to this point on the ICO-related deals, and it's about where the value is. That's what you invest in. You invest where you think the value is. Is it in the token or the company? What is the company? Who are the people?
Alyse, so I'm curious. I mean, you were a kind of traditional venture capitalist also. Is this the future of venture capital? In other words, the way we all view venture capital and have really for decades and decades and decades, which is investing in company, getting equity back. Is tokenization, is that the future? Is venture capital actually finally having a fundamental shift?
So I think that investing in tokens will be a portion of venture capital going forward and will be an important way, a critical way for companies to raise capital. In 2013 was the first ever token sale, which was issued by a company called MadeSafe. So as a traditional venture capitalist and with the practice I was at the time, we did diligence on that company and investment opportunity just as we would with any other investment that we had made in equity. Of course, understanding how the return and risk dynamics are different and what our LPs are exposed to is critical, and I think that's what's being developed in the industry now. And so people are looking at the changing dynamics of what liquidity is because it's immediate, it's instant, and frankly, it's harder to manage for LPs than other forms of traditional equity liquidity would be. And best practices around how to do that are being formed now. We're in the process of doing that. So at StillMark, we recently invested in a very traditional round in a company, knowing that that would convert likely to a token and immediately liquid format somewhere down the road, and that we would have to answer the question of custodianship for LPs where we should be managing something that essentially fluctuates with the public markets or where we should hand that over to LPs. And as that's quite different from the traditional venture practice, it's something that requires a lot of thought and dialogue with our investors.
Yeah. Oh, I was just going to comment too on the intersection between tokens and equity or other forms of value. I think that's going to continue to evolve. And you're going to see it, the interplay unfold in pretty interesting ways. So you have this almost commodity-like concept of the store value that Adam mentioned, and that's really important whether you're in the US and you're a law-abiding wealthy person, or you live in an emerging market and you're dealing with inflation, or you're dealing with demonetization or whatever it is. You have new business models, new use cases, utility tokens that I'm sure you guys have heard about ad nauseum and that folks are looking at. And then you have this realm of security tokens, and Bart and his team helped pioneer this in some ways for their own firm. But I think this is one area, if it hasn't already been talked about a lot today, you will hear a lot about it. as we go into 2018, and you can tokenize an underlying asset. And it could be almost anything in the world, and you can break it up in different ways. If there's equity involved, if there's not. Maybe you want to tokenize the equity in a building, in this building, and the tokens represent equity ownership in the building. Or maybe you don't want the equity exposure, but you want the income exposure to the cash flows that are coming through the building. So
can you explain, what is the advantage to that? So I guess it was Adam who was up here, and he was talking about how, for most people, if you're buying a bottle of water, cash or Visa still makes more sense than doing it via Bitcoin. Take the equity in this building. What is the value of tokenizing the equity in this building as opposed to how the equity is presumably done now?
Super simply, it's fractional ownership, which isn't always possible, in a globally 24/7 liquid form. Liquidity.
Yeah, the liquidity is the key here, and Alyse mentioned it. The average Silicon Valley venture-backed company now takes 9.4 years to go public, and there's many LPs in the room, and you guys feel this pain, right? This is Airbnb and Uber and Pinterest and Spotify. 9.4 years is a long time. And so what we're seeing with these token offerings is these companies are more like networks, and these token offerings aren't happening in 9.4 years. They're happening in 9.4 weeks. Or 9.4 months. It's a dramatic improvement in the liquidity profile of seed stage investing. It doesn't make it any less risky. It's still super risky, super high risk, high return, but it's an improved liquidity profile, and it's changing the dynamics of venture.
Two questions about that. On the liquidity side, when you say liquidity, the liquidity, and correct me if I'm wrong, because you guys are all much smarter about this than I am. To be honest, most of you are probably much smarter about this than I am, so you maybe got the wrong moderator. So let me ask, but when you say that, it's not necessarily cash liquidity. When you say liquidity, the ability to sell tokens, but it's not necessarily for cash, and there's not often buyers for this stuff.
So the tokens have a dual function in these tokenized networks. There's a speculative function, and then there's an offering, an ICO, and then they usually have a utility function in the network as well. That speculative function is not just to raise capital to capitalize the network or the business, but they also trade on cryptocurrency exchanges around the world, so you can exchange them for Bitcoin or for Ether, for US dollars, euros, or yen. So they are very liquid. Your point, but it's worth noting that there's 176 crypto hedge funds that have launched in the last year, and there's the illusion of liquidity, I would argue, in a bull market. I ran a hedge fund for a decade, a microcap fund, and in a bear market, the bids go away. So I think it's important for the LP community to understand there is kind of this veneer of liquidity, but what you don't have is institutional buyers with deep pockets that will come in and buy something if it's down, say, 80%, or market makers in the traditional sense in the regular capital markets world.
Let me ask a much more practical question, which is there's a former endowment manager who always used to even complain about getting stock distributions. He used to say, to the fund manager, I gave you cash, I would like cash back. In this case, I mean, if you're an LP, most LPs literally just can't handle tokens right now. It's not something they can deal with.
So I think that one of the innovations in venture capital that's happening is I have optional liquidity right now. We hold tokens in Aragon, Repio, a bunch of these tokens that are openly traded on the market. And it doesn't mean that I have to distribute in token form. What would end up happening is I would figure out how to, what is the exit routine? It would be me going to an OTC trading desk, and then is an important question to ask, by the way, if you are thinking about investing in a crypto fund. What OTC trading desk do you use? I actually wrote a blog post that everyone should read. It's 6 questions to ask a crypto fund. This is the most relevant audience to read it. It's my last one. Just type in Adam Draper. And it was on my Twitter too, @AdamDraper. But basically you go and you'd sell for either Ethereum or Bitcoin, and then you would cash out because those two have the highest liquidity of anything else. And I'd say right now most LPs in the room would take Bitcoin. Am I wrong?
I think you're wrong.
Yeah.
Okay,
how many people, if
you're an LP, raise your hand. Wait, if you're an LP, raise your hand.
Okay.
Okay, would you accept Bitcoin?
Mental picture?
No.
You've got you should talk to him in the back.
Okay, if I were to distribute, who would accept Bitcoin as a distribution? Okay. Okay, we should hang out.
But I guess my question, Alyse, Do you feel, though, that the LP community, is this just a time issue? In other words, this is just a question of institutional investors getting their heads around this more, getting functions in place in-house, and this is an issue today, but won't be an issue in whatever it is, 3 years, 5 years?
Well, I think it's a time and also a tools issue, so it's just hard to store safely cryptocurrency. And then, frankly, the ramp up to understand how the markets work and when you should trade in and out of a cryptocurrency requires essentially a full-time team. And so that's quite a burden to place on LPs if we're immediately passing back tokenized liquidity. One of the things that I wanted to mention on this subject, as Matthew had referenced earlier, is the ability through tokens to share new resources. One of the trends that I'm paying attention to and have been speaking about for a while is how the type of resources that can be shared totally changes, and why tokens are necessary for that. So what we're seeing now is the intersection of 3 trends that we've been talking about for years, which is sharing economy, IoT, and cryptocurrencies. Because with cryptocurrency or digital tokens, you can start to share device-level resources. And so these are the types of tokens, utility tokens, that I think start to make sense, where there's a justification for an intrinsic value of the token and a reason to do an ICO. And so when you're looking at what sorts of ICOs you want to participate in, it's, I think, important to ask if that token's necessary for the network it's used within, and if being necessary, it can develop some sort of intrinsic value. And where I feel most comfortable now is in the IoT and device level resource sharing and how tokens incentivize or allow for that.
I was just going to make one more comment from kind of the LP perspective, because I sat on that side of the table for a long time at Goldman Sachs. My co-founder was a portfolio manager and led the cryptocurrency research at the University of Chicago endowment. And we're used to thinking of different types of assets through different risk parameters, and we're used to getting compensated as investors for taking different types of risk. You can get compensated for taking beta risk or duration or illiquidity risk in the case of venture capital funds or whatever it is, but you expect to be compensated for that. Here you have a new type of asset fundamentally that has new types of risks. And I would argue, as we've seen and will continue to see, investors are very well compensated for taking those risks. And that's new stuff. That's things like custodial issues and operational complexity and like the whole sort of psychological element to this. Getting over a psychological kind of barrier is actually a real thing that you should be able to think about and get compensated for, because when most of the population can't get
Can I ask about that psychological risk? So you left Goldman Sachs last summer, so not this past summer, so July, so 18 months ago. I'm curious, when you left, was the general feeling, oh wow, he's going to compete with us, or was the general, in other words, was it more like, was it kind of good luck sincerely, or was it more like good luck, oh, he's screwed, he's going to something really dumb?
I think it depends who you talk to. The people that I talked to and took through the thought process, it was sincere. And to be totally honest, I've been back, people have now seen the headlines and what they're working on, but I've been back more times than I thought I would be. I was back 10 times the first 4 months after I left the firm, helping them kind of come up the learning curve and think about how their businesses can be applied here. So it was sincere. Yeah,
I think the investment banks and hedge fund managers are pretty open-minded about it. In kind of an ironic twist, some of the most kind of emotional conversations I've had with people about blockchain technology or crypto is with other venture capitalists. What's interesting is there's been about $300 billion of liquid value created in the last 12 months. That's essentially the largest liquidity event in the history of the venture capital industry, and most generalist venture capital firms did not participate. I've gotten in kind of arguments with a lot of my friends, and they really don't believe in crypto, or they might like blockchain technology, but they have problems with valuation, or they don't understand the liquidity. And what I've come to realize over time, and it's kind of a painful realization with a lot of my friends on Stand Hill Road, is that a lot of venture capitalists like to talk about disruption and innovation, unless it's aimed at their own business. But venture hasn't evolved much in 40 years, and so we're finally seeing, Mark Andreessen likes to say software is eating the world. Maybe protocols are eating venture capital. And so when we saw this type of activity about a year ago that Adam Draper mentioned with ICOs, we said, oh my God, we're blockchain capital. We invest in blockchain technology companies. This is potentially bad for us. So we had this existential threat, and we decided to disrupt ourselves. We did our own token offering and basically created a liquid venture fund. So we have firsthand experience of what the ICO process is like.
Adam, are tokens securities?
Okay. Securities can be tokens, and
oh, this isn't going to be a rectangle square thing. Is that where you're going on this?
It is.
Okay.
No, it's that tokens can be securities, but the like Bitcoin, I don't think is a security.
You don't think Bitcoin's a security?
No, I don't think Bitcoin's a security. I think you could make a good argument that it's more like gold, so a commodity might be right, and so I guess that's a security. So yeah, there. That's my answer.
Let me rephrase for all you, and this is just going to be a quick yes/no down the line. Pick a time period, a year, 2 years. Is the SEC going to be actively regulating basically all ICOs and all token offerings?
Yeah.
Everybody agree?
Some. At least.
What would be the exception? Just because the SEC has no more staff, so they have to choose, or?
That's part of it. Listen, the regulators have a tough problem. This is not quite a currency. It's not quite a commodity. It's not quite an equity. It's not quite a peer-to-peer payment technology. It's a little bit of all of those things and none of those things at the same time.
To the credit of the SEC, too, they've been very thoughtful about everything that they've released about it. It's like, yeah, don't scam people out of money. Don't steal money. That seems like a relatively good rule that they are applying to the industry.
Not one that's being followed necessarily, but one that they're applying.
Yeah, that they're applying, and they have been very thoughtful. Everything that they've released, I'm like, yeah, this all makes complete sense. And they have a really difficult. It's a difficult problem. Like this new thing came out of nowhere, like the internet, and like took over the world. And they're worried, hey, if we regulate it too much, like we might lose this new technology to a different country, because that's what's going to happen. Like, a country is going to adopt this and become the superpower.
Yeah, there's a lot at stake, right, in terms of economic progress, and you think about what different nations are considering. And I agree that they've taken a good approach, and I think that'll continue because they don't want to stomp this out. And at the same time, it's important. Everyone uses the word regulation and what's it going to look like, but I think another word that people need to be thinking about is self-regulation. So the onus is on the people and the actors in the space in various countries to work constructively with their respective governments and regulators to figure out regulation and drafting things that make sense to foster this.
I'm curious, for any of you, Alyse, or for Adam, do you feel, there's obviously so much talk about scams when it comes to ICOs, and even just yesterday, obviously, the SEC knocked something down. Is it fair, do you believe, I guess I'm going to ask a percentage, but how significant do you feel the scam factor is within ICOs? And I'm not just saying ones that are stupid, which is different than an active scam.
So I actually think that the community self-regulates pretty well.
Really?
And if you read, if you are
when you say that, how is the community self-regulating?
So most people go to Etherscan or My Ether Wallet and they say, hey, this is a bad token. And then they flag that account. And then that's like the self-regulation. Like it happens in a very fluid, liquid form. You have to trust, these entities inside of the system. But I think that there's so much debate. It's like such a ferocious community that if you piss them off, you don't want to. But
yesterday, you have the SEC yesterday knock something down that raised hundreds of millions of dollars. It says it doesn't actually, there's no there. How big is the scam problem? And I guess I don't mean it just from people losing money today, which is obviously an issue. I mean it kind of for the long-term health of the market and for you guys being able to, when I say you, firms like yours being able to raise money from LPs who might be concerned that they're putting money into something that's not real.
Right. So I think the initial point I made in response to a question on the panel was that diligence needs to be matured, and that the companies operating in the space need to dig deep and really understand the technology they're investing in. What I've been most concerned about, frankly, is seeing some establishment funds participate in pre-sales or ICOs where it seems to me, based on the diligence that I've done and that has been done by advisory partners in my network, that the other venture capital team has not done diligence. But their investment, I believe, signals to individual investors that the company is safe and that the token will have value. And so there's a little bit of a broken trust model. Of course, though, to come back to the original point of Bitcoin and cryptocurrencies, there shouldn't be trust needed, actually. And so what the call for to the community is the same for investors, which is to be self-sovereign and self-efficient in how you understand the technology. And where I think the SEC will be important important is making clear how they'll regulate, which will reduce costs for companies, because of course there's a cost incurred when you have to be flexible to respond to changing regulations. But I hope they'll do so modestly, because frankly what ICOs have done is fix some of the areas where venture capital just wasn't working. So what we've seen is non-traditional founders and entrepreneurs have access to capital through the wisdom of the community. We've seen people be able to capitalize their companies outside of Silicon Valley or Los Angeles or New York, and folks that wouldn't have success on Sand Hill but have a robust product and technology find success. So to offer a very quick example of that, there's a woman by the name of Krista McFarlane who's Atlanta-based, so not a capital hub, who was able to as an African-American woman founder, raise $7.2 million for a company called Patientory, which I believe is the largest Series A of African-American woman founder. I don't think she would have found that kind of success for her healthcare tech company on Sand Hill Road, but through the wisdom and knowledge of the community on how blockchain technology works and how it can create efficiencies in record management was able to. So I hope that those sorts of opportunities are preserved when the SEC clarifies the regulatory environment.
You talked about the IPO.
I think another thing that it's important just to note is that, like, you're investing in people at the end of the day. And so, like, the scams at the end of the day are not, you don't know the person at the end of that line. And so it's when you're looking at someone and they've been in the industry for 6 years and you've developed trust with them, that's where most of the non-scam comes from. The
scams are easy to spot.
But you say that, but $600 million went into a scam. I mean, but easy to spot maybe for you, but not necessarily for all the folks who are investing in this.
Yeah, you mean us as amazing fund managers
That's
are
what I'm
able
saying.
to, so LPs
okay, well, let me ask
probably
just,
think about
have
that.
any of you, and you don't have to say what it is, have any of you been scammed yet? To your knowledge is a better way to put it.
No, I think, no. I think that there's something to be said in this industry that I think it demands specialization. You don't give someone with an art history degree $500 million to go invest in cancer biotherapeutics. Biotech is a highly specialized industry, and I'd argue crypto and blockchain is pretty similar. We have a team of 8 that spends 150% of their time, 7 days a week on this stuff, and it's really hard to keep up. So if you're asking one partner at a generalist firm that is a fintech guy or a gal that is spending maybe a third of his time on crypto, it's an impossible task. And so
we actually take an approach that I think helps with this, and it's kind of how I wanted and was thinking about my own money in the space before this, which is to be opportunistic, because just because something's attractive today doesn't mean it will be in 3 months. The pace of change in the space is so rapid, and regimes change so quickly. We don't want to be pressured or obligated to deploy capital into a part of the cryptocurrency market that isn't attractive, or suddenly becomes unattractive, or suddenly becomes regulated in a way that we don't want to be near. So it's very sort of dynamic, and being able to kind of nimbly move across different parts of the market. So for instance, right now, most of our investments are in the bigger liquid cryptocurrencies that you know what they are, and you know what kind of risks they don't face relative to new ICOs and regulatory issues and things like that.
Final question, this is just to go down the line because we're basically out of time. One of you, I can't remember, talked about how, or I guess Bart, was you talked about how crypto is disrupting venture capital and how traditional venture capitalists haven't necessarily capitalized on it or gone into it yet. So a quick question, which is going down the line, in 10 years, is the majority, let's call it venture capital, let's include all of what you're doing, will the majority of venture capital be being transacted in some sort of token or in cash or in equity? Traditional equity.
So I have a longer answer. Sorry.
So go with the short one.
No, I'm going to go for the longer. Someone else had 280 characters when basically, tokens are networks. They aren't companies. Okay, so this is it's a mental model that you need to try to wrap your head around. There's no CEO of Bitcoin. Who are you going to come after? It's a huge community of these machines who are solving this one problem. And the true utility tokens are all built that way. If there is a CEO, it is a company, in which case it will be an equity-based ownership model. And maybe token model. It depends on how they aligned incentives. But we as investors are now having to make decisions on how much of the company do we own? How much of the tokens do we own? All these are all new. There isn't good or standard or any of those types of things yet. And so if you're an LP and you're like really, really worried about an industry, don't go into this industry. Like this is a new industry. We're inventing something. We're inventing how the standards work. I mean, we sound confident up here, but like it's anyone's ball game.
That's a good note to end on, because I've got a red light up here. Thank you all. Appreciate it.